Private markets investing, a growth bonanza. Who needs governance? Welcome to the Better Boards podcast series, the podcast for chairs, CEOs, non-executive directors, company secretaries and their advisors. Every episode is filled with practical insights and learnings from those inside boardrooms. We discuss what really matters and highlight actionable steps you can take to enhance the performance of your board. Investing in private markets, such as private equity and private debt. In areas such as infrastructure, real estate, exponential technologies, and natural capital is a flavor of the day. It has hit the media. There's a lot of talk about it. Huge amounts of money, huge numbers are circulating around. And yet, I thought it's worthwhile to reflect a little bit on governance in this specific context. So this podcast episode might be a little bit more specific, but if you are in the world of finance, in private equity, private debt, if you're an investor, it might be worthwhile to listen. I'm delighted to talk with Dr. Eelco Fiole. Eelco has 30 years of international finance experience, including 2 decades as a non-executive director, CFO, and chief operating officer in alternative investments with teams in Zurich, New York, and London. The guy has 8 degrees. I mean, I was struggling to get my doctorate, but he has 8 additional degrees to his doctorate. So, worthwhile to listen. As I said, it might be slightly more specific than previous podcasts, but anyone who is interested in this world, tune in. And if you want, reach out to Eelco. Eelco, lovely to have you. Thank you so much for making time to contribute to the Better Boards podcast series.
Thank you very much, Sabine, for having me.
At the moment, private markets are all over the place in the media. Soon taxi drivers will start about investing in private markets. It's omnipresent at the moment. So as retail investors gain access and more products are created, there continues to be this great promise of highly attractive returns.
Yeah.
Given these great expectations of returns, why should we at all talk about governance?
Yeah, that's an excellent question. So let me just, for context, because you rightfully referred to the taxi driver. So first of all, till 2030, so that's 5 years from today, global volumes are expected to double to $30 trillion US, with 50% in the US, 20% in Europe, and 30% in APAC. And that volume is doubling, representing both institutional investments as well as private/retail investments. So, just by way of size, this is already going to be increasingly important. It covers sectors such as infrastructure, real estate, new technologies, natural capital, and so on. Now, the sector already, this is known for a long time, but as this volume is increasing, the sector has features which yield a lot of complexity. There's valuation opacity, difficult to value positions, transparency, deficits, there are conflicts of interest in the structure, there may be multi-layered leverage, people are locked up in those investments, there may be liquidity pressures. And so private market investing comes with a lot of issues. So yes, you're right. I mean, there are good reasons to invest in private markets for returns expectations, but also for things like beating upcoming inflation or covering for that into real assets. But it doesn't come without its issues. And many of these issues are very technical, and people are not necessarily aware that this complexity is there. But when things go wrong, and sometimes things do go wrong, we will have a loss of investor confidence. And that's where governance comes in. Also, and I should say this, because not only is the volume increasing, but we also see, as you just alluded to, a further what people call euphemistically democratization of private market investing into retail, i.e. everybody can invest in private markets nowadays and going forward even more. But also on the institutional side, we see new investment vehicles such as evergreen funds and continuation vehicles, which introduce more complexity as well and potential conflicts for institutional investors such as pension funds, sovereigns, insurance companies, and so on. And so governance, and we'll talk probably a little bit more about that, but so governance becomes very important in terms of having those investor interests well represented in these structures. The information asymmetry between investors, let's say LPs as we call them in the business, and GPs, asset managers, is already very high. And if you think about retail, your taxi driver just now, then you can imagine that the information asymmetry is staggering, right? And so that invites...
And this is where the danger is. This is exactly where the danger is. And actually why we bring up this podcast, to basically show what role governance can play in all of this. Yeah. Maybe let's talk a little bit about the role governance can play in this specific context, and what does good really look like?
Yeah. So the main problem around private market investing, where governance plays an important role, is trust. I specify this as the following. The asset manager, the GP, the general partner, needs to project trust to investors for a variety of reasons. One reason is basically competition. Somebody would say, listen, I got a great strategy. It promises this kind of return. You should realize that greed is not a strategy, right? And so how else are you going to project trust that investors say, I will invest with you and not with the brand name, or I will invest in your strategy above another strategy. And there are, a platitude. There's so many multitudes, I should say, a multitude of strategies out there. So that's the first topic. How do GPs project trust? And the main way of, not the main way maybe, but certainly an important way is to basically say, listen, have a look at my governance, the way I'm set up. You can trust me. I got it all checked out. You can sleep at night. Now, the trust factor is mirroring that. The trust factor is also the main topic for LPs, for investors. So let me turn it around. How do investors maintain trust when they put money to private market vehicles, given what I just said about valuation problems, transparency problems, conflicts of interest, and so on? You would invest something, you would do a due diligence, you would invest something, and then you move on, to your next thing. And so maintaining trust over time for LPs, for investors, certainly with long lockups, because that's basically the rule in this business, is key. Now, again, the LP would look at GP and say, okay, so I don't have the time and etc. To continuously review and look at what's going on. So I have to rely on the governance structure that represents my interest, and so that needs to be organized. So it is the main topic is in this difficult world nowadays. How to project and maintain trust on both sides of the investment transaction.
So we know that a lot of non-executive directors are listening to this podcast, and also, of course, company secretaries.
Yeah.
How can they inject trust? What can they do to basically contribute in terms of their behaviors, their contributions at board level, that this trust really develops?
So I'm of the firm conviction that trust needs work. So it's not just looking each other deep in the eyes and then say, I trust this person, or this person has worked for a major firm, that's enough, or this person has an MBA from a brand name school, that's enough. That is not the idea. I think we need to organize for trust. Now, what do I mean by that? If you think about the legal and economic terms of an investment, they should reflect the expected behavior of GPs so that the incentives become clear and not automatically jump to a standard sort of incentive structure, with carry that everybody does, because that is what we call best practice in the industry. Every investment is situational. The documentation needs to reflect that. Standard off-the-shelf documents from your lawyer may not necessarily cut it. And so, as I said, the terms and conditions should reflect this behaviors of GP. And so your model behavior there, and as a result, you can, if you do this well, hopefully you can trust the behavior of the GP. So that is one element. The second element is that you need to look at governance wisely. So literally who is serving, but also what are the incentives there, and see governance, as I say, as work, as ongoing due diligence. So not just your initial due diligence, but say, you can have a periodic review, you can have an LP advisory committee, maybe. But governance is work where the directors will need to take a close look at how things are going. Now, if I say a close look, that means relatively often, not just shoot and forget, but that would include things like scenario analysis and for around those conflicts that I just mentioned, valuation, liquidity, leverage, and so on, right? And boards will need to go into these kind of things and say, well, what happens if liquidity comes knocking on the door anyway? And we need to deal with that. So, as I say, governance is work, and when that work is being done, trust also develops.
So let me probe a little bit here, Eelco, because this sounds still quite on a high level. Can you specify a little bit more what directors would need to do? What do they need to look out for to make it really practical?
Yeah, so it's all about incentives. And so, when is a GP being paid? For what is it being paid? And that kind of consideration, that needs to be, as I say, modeled into legal documentation and in the way that we exercise governance, i.e. oversight, meeting agenda, scenario planning, these kind of things. So it is not just, okay, we have a fee structure and we have a fund documentation, a legal document that governs the investment and governs the fund. That is sort of standard in different fund domiciles. You would need to look at, in this specific case, I'm going to put money into this, and what is the behavior that I hope to see from the GP, from the from the investment management company, from the general partner, and how can I model that into both economic and legal terms, i.e. in fund documentation, in incentive arrangements on the one hand, but then also in behavior in terms of oversight, reporting. And as I said, every investment is situational, and we need to adapt as we travel, right? As we travel along, we need to adapt those two dimensions, legal and economic and behavioral, as we go forward, just to sort of be early aware of potential issues. But following the money, i.e., how are GPs being paid? That is, I think, a key aspect of it.
And I mean, boards in this specific context are at times not very well balanced yet. So the truly independent voices on the boards are very often in the minority or even lacking.
Yeah, this is something that's what I mean with the representation of an investor. I've seen many cases where things go wrong, even at where investors would have high concentration risk in the investment, literally owning 20, 30, or maybe even above 70% of an investment, and would not be represented in the governance structure. And so I think that is clearly a point of concern. How are these interests being represented? What kind of powers does an LP advisory committee have to the board? There's obviously the fiduciary duty that is also there present. And so investors would need to say, if I cannot have proper representation of the interest, including potentially external that look at various dimensions of the investment, so for example, a risk focus or an industry focus or something else, then I'm not going to do it. That's why I said before, greed is not a strategy. Just promise returns over 5 years or 10 years. Who knows what's going to happen then, right? By then, it's just not a strategy. So you will realize that I'm not pleading here for regulatory intervention, even though I'm certain that regulators are thinking and so on, and there's a lot out there on this front. I'm just interested in flourishing of the business and flourishing of the investment, let's say, and And that would do good to both investors as well as investees, right? As both GPs and LPs.
And Eelco, at the same time, I know actually directors who say, hey, this would be an interesting opportunity for me. Maybe I worked for banks before. I know the world of finance. I would like to go in there. At the same time, I know that the barriers to be considered for board positions in this context are very, very high. It's very often a closed shop.
Yes, unfortunately it is. So there are one or two aspects to this. I think one is that the level of specialization in finance is very high. And so if I look at my own practice, I would literally only take mandates where I feel comfortable, let's say. So I would not serve on a coffee maker. I'm looking at my coffee now, or at a producer of paper clips. I have no clue about paper clips, right? So that is one thing. I think the humility has to come in. So that is one, where you build a reputation for being a bit of an expert in an area. And I agree with you. I do not have a recipe there other than be recognizable for what it is that you bring and network around it. I've been doing myself this kind of work now for 10 years, and it's been a difficult, but it's true.
So any tips for directors how they could basically be recognized as a potential candidate for a seat around the table in this context?
So every board, how do I say this positively? There must be added value. That's why I spoke about humility. So the question is, what value does one bring? Or could one bring to a board? And saying about yourself, okay, I'm a great person, that is not enough. It needs to be pretty concrete, which means that the areas which we have weaknesses, where we maybe should not try, let's say, to be on the board because it's going to be useless. So it's about, I think, about focus, and then make that focus known in the network. But it's, as you say, it's an uphill battle. It's not easy. The other thing is that, so I've now put a lot of focus on investors, right? And I think investors increasingly understand that good governance works to their favor, both if it's their own money, or if they manage money for others, for principals. And so governance is this kind of guarantee, or the only ally, I think, for an investor. And I think that's what investors increasingly understand as well. I mean, the world's becoming a difficult place. You need governance.
So why is it, in your view, before we come to the final question, why is governance, particularly in this world, so important? Just to really hone it in.
Yeah, it's to get proper representation for investors and also for other stakeholders potentially. It is also to keep your checks and balances on what's going on underneath. And it is ongoing due diligence, So it's not just leaning back with a cigar, as maybe years ago it was the case. It is ongoing due diligence, it's ongoing work, and it manages the asymmetry between investors on the one hand and GPs, asset managers on the other hand. To build trust, basically to create a trust infrastructure. So it's all about the trust infrastructure.
Fantastic. Thirdly, Eelco, we have to come to an end. And there's always this question, what are the 3 things our listeners should take away from this podcast?
So I think I've already sort of briefly touched upon it. The first point is that governance is work. So that means shaping the terms and conditions for investments along lines of expected behaviors, or what you want to see and reflected in documentation, including in the governance reality, right? As I said, meeting agendas and so on. And it is real work. So it is ongoing. The second takeaway, I think, is more for GPs. Basically, understand what I call the mechanics of trust. Just going out there with a return promise is, in my mind, not enough to attract capital and keep people happy. So that is I think from a governance perspective, you should expect that question, how trust work, and the other way around. GPs would know and would start to check those mechanics of trust and put these into place and go market those, if you will. And third is legal documentation is just not enough, okay? And certainly not sort of best practice, what people call best practice, standardized off-the-shelf legal documentation. That is not a guarantee. You will need to model those terms in legal documentation, including scenarios, as I just mentioned. The scenarios maybe not so much in the legal documentation, but certainly in the incentive structures. Yeah.
Fantastic, Eelco. Thank you so much for contributing to the Better Bots podcast series.
Always a pleasure. Thank you.
This podcast episode is part of the Better Bots podcast series, brought to you by Better Bots, the provider of board evaluation solutions. Get in touch if you are interested in joining our growing community. If you are interested in learning more about our work or our innovative board evaluation platform. Our clients use the platform for both internal and fully facilitated external board evaluations. We at Better Boards are always delighted to hear from you. You can best reach us at info@better-boards.com. Thank you for listening.